Good morning, ladies and gentlemen. Well, we have to admit last week we were completely wrong. Not only did the market go and make new highs, but there are absolutely no signs whatsoever this week that that trend is going to stop anytime soon. If we start with a look at the 10-year note yields, we will notice the implosion of the Bollinger Bands, signifying a build-up of future volatility. The market is now trading almost at a singularity. It is in a range which it has been in almost all year as a preferred price point, and that is a significant tell that something big is about to happen. We think in the on the upside in yields, this kind of non-volatility. So basically, since the beginning of 2017, we have been in an effective 15 basis point range. This is not going to last much longer, and it's telling us that there will be an explosion of volatility in the bond markets at some stage. Funnily enough, that does not portend badly for equities. It actually portends quite well for equities, and we shall see why in the later clips. Much the same thing is true for the European markets. If we have a look at where we were at the beginning of 2017, right here, and we can see that we haven't moved a basis point away from where we were at the beginning of the year. Sure, we had 15, 20 basis points on the upside and 10 basis points on the downside, but we are effectively where we were. The Bollinger Bands on the weeklies keep on coming in, and will probably keep on coming in for the next 2 or 3 weeks. And after that, we expect an explosion of volatility one way or another. Still think it's much more likely to be up, but open to the outcome they might be down. If we compare the beginning of the year in terms of yields, and here we are on the 5-year note, this is where we started the year, and we are very much there. We haven't moved more than 2 or 3 basis points throughout the year in 5-year notes, and we compare that to where we were at the beginning of the year in the dollar. In the dollar, we were trading at 102, and now we're trading at, well, let's call it 93. That is, a good 9% down in terms of the trade weighted index of the dollar. We think that trend is likely to continue after some backing and filling up towards 93, 93 and a half. It is just a massive trend that we are at the beginning of rather than at the end of. Well, what is going on? It seems to be clear that the budget deficit in the States is going to explode, and that it's going to take a cheaper dollar to fund it, to compensate people for the risk of holding dollar assets. So that is probably what is going on. I know that 99% of the market doesn't understand or doesn't appreciate that fact, and they keep on stubbornly buying dollars because they think that US interest rate differentials are going out, and yes, they are. US interest rates are consistently higher and going higher compared to the EU or Japan or many other countries, and therefore they think the dollar should be strong. Well, quite the opposite. The dollar will be weak and get weaker as the interest rate differentials go out, in a sign that the budget deficit is about to explode under Trump, and as a result, it needs higher and ever higher interest rates or a cheaper and ever cheaper dollar to sustain the flows into the US currency. this week I wanted to have a deeper look into our spread indicators so that I don't recommit the error of last time thinking that we are ready for a move lower in equities. We just aren't. There isn't a single spread indicator that is signaling that. XLP, XLY, still very much in a downtrend. Every time it rallies, it gets smacked back. And every time it gets close to those trend lines or the moving averages, it gets smacked. Risk on as far as XLP, XLY is concerned. SPY over TLT, still above all the 200-day moving averages, the 50-day moving averages, doing very little, but having surpassed the all-time high from 2007, it is showing absolutely no signs of breaking down below into the range, and these are the important levels to watch. You have to say that being bearish of equities at the moment is pissing in the wind. There is no reason to be so until these levels are breached on the downside. And since we think that the volatility in bonds is actually going to take the direction of higher yields, i.e. lower TLT prices, expecting this spread to turn down would imply a huge move down in SPY, which at the moment seems unrealistic. It is much more likely that as TLT goes down, SPY actually goes up, and this spread melts up into year end or the beginning of next year, indicating even more risk on. If you look at a very momentum driven spread like the SOX index over the Japanese yen, i.e. what is the technology telling you compared to the level of liquidity provided by the yen, so very fast momentum driven spread. Well, since it gave you a warning about what was about to happen when it broke up above the 200-day moving averages and stayed there and turned them, which would have been sometime in October, let's call it September, October of last year, it has never looked back, and it keeps on making new highs. So even with the yen turning in the last couple of weeks, it has actually gone higher and keeps on giving you a risk on, immediate risk on signal. There is nothing bearish about this chart. It is in a huge trend and could have deep retracements without having any negative effects in the long term. This is very much still a immediate risk on chart. SPY over IEF. IEF is 7 to 10 year treasuries. It busts through the 2007 high. It is absolutely not giving you any momentum divergences or anything. It is basically saying we're sailing higher, we've bust through the top of the channels, we don't care, we're accelerating, probably into a climax, but who cares, accelerating. It is just indicating a vast amount of risk on and absolutely no reason to be bearish of the equity sector. This is SPY over GLD, so equities over gold. If we are looking for any sign of risk off behavior or worry about what there is ahead, we don't see any. Very much within an uptrend channel, very much above the all the moving averages, 50 and 200, very much a risk on attitude. So even if we look at gold to give us some early warning, well, there is none here. XLK, against SPY, right at the top of a trend channel. We will see that NQ has gone up 9 weeks in a row. It's probably due for a rest, but that's all it is. It's a rest. This is what is driving it. We would suspect that the market was going to go a bit sideways and then melt up when all the overbought conditions are slightly out of the way. It is certainly what we have been saying for a long time. XLK's America. Don't invest in anything but XLK. When the timing is right, just buy the dip in XLK and it'll be far more profitable than investing in the overall American economy. This is QQQ over IWM. So this is a very technology laden ETF against the Russell 2000. Why is that important to look at? Because the Russell 2000 should give you the highest yield and therefore the highest appreciation in terms of your equity investment. It is one of the riskiest investments you should make, and therefore the reward you should expect from it is very high. Well, it is nowhere near as high as what you get out of technology, which is a far safer sector. Since 2008, it's done nothing but make higher highs and higher lows. This is the epitome of a bull market. It is going ever higher. So if QQQ, which is basically technology, is giving you even more performance than IWM, why would you look at anything else? It makes no sense whatsoever. QQQ, XLK, those are the drivers of the entire rally at the moment and for the past several years back. This is a chart that we think is very important. XLK over XLI. Again, technology over the industrial sector. Well, we are busting through the all-time highs. We are going higher. This is this is more confirmation that it's not the traditional industrial conglomerates that are leading this market. They're providing stability to the market, but the sharp upswing is provided by a get me all the commodities, get me all the technology stocks you can, get me as much Apple, get me as much Amazon, get me as much of anything as you possibly can. And this is reflected in the spread. Tough to be bearish on the market while this kind of behavior is taking place. This is probably one of my favorite charts for the long term. This is SPY over SHY. SHY is 1 to 3 year treasuries, therefore it's close to cash. You might as well say it's cash. So if you ever look at it, what is it saying? That ever since the market turned in 2009, with one very notable exception here, the market has been in almost a continuous risk on phase. The market has been saying, give me risk all the way. And at the moment, we are at the top of the trend line. Could we see a 5% retracement? Yes, we could. But just the attitude of these lines, of these moving averages, is nothing like the attitude if we go back in 2007 and 2008. The market in 2007 did a lot of work going up and down, turning these moving averages, and then in 2008 it was ready for the move down. It took a whole year of price action. Now, Could that year start today? Yes, it could, but it's terribly unlikely. We are now in a trend. Uh, the likelihood is that we break even higher after some consolidation of this trend. It might take a week, it might take a month, but I have no doubt that we are going to break higher in this trend over the coming few weeks. Well, having seen that everything boils down to technology, let's have a look at what is going on in NQ. NQ has basically done 1, 2, 3, 4, 5, 6, 7, 8, 9 weeks of higher prices. I think the record is 14, but who cares? It is above the Bollinger Band. It is likely to move sideways for a couple of weeks before resuming its move. We are in the probably the strongest seasonality part of the year. It is unlikely that that index is going to do anything but move sideways for a couple of weeks, given the attitude of the MACD and everything else. So we cannot expect anything but a sideways move before a stronger move up into year end. If we look at NQ on a monthly, we can see that it still has room on the Bollinger Bands up to 65.25, and next month it'll be over, easily over 6600, probably 6700. So as soon as the weekly Bollingers have allowed it to rest a bit and take off, we fully expect that the NQ is going to trade above 6500 easily by the end of the year and during the Santa rally. There just seems to be no stopping it. Everything is overbought, everything is fundamentally overpriced, but at the moment the weight of money is just too much. It is probably in the blow off phase. You can't fight it. It is almost impossible to fight NQ, and one should allow it or embrace it and allow it to go higher by buying dips. On a daily basis, and this is NQ daily, while it remains above 63.50, the outlook, and closes above 63.50, the outlook is still immediately bullish. If it were by any chance to break that, it'll be around the 6,200 mark that that it'll have to prove itself. I fully expect it to hold around the 6,200 mark and then move higher. It is unlikely, in our opinion, to move below 6,200 before the end of this year. And finally, look at XIV, which is just not quitting. Volatility is still going down. It's still telling us that it's very much risk on mode. It is overbought. It had a very nice bearish setup, but as we said, as soon as it broke this 110 level, the market was bound to make new highs, and it was bound to encourage new highs in all the equity markets. That's why we didn't sell it again. Once we got stopped out, that was that. It now looks like we certainly should have a bit of a pullback, but into year end we can see nothing but higher prices in XIV, therefore lower vol, therefore more risk on, therefore higher prices in NQ, well above the 6500 level by Christmas. Well, the biases for next week are slightly changed. Still think that the US and European bonds are about to make a very large move, something which is not being anticipated by the market. Therefore, buying volatility both ways is still important. ES if we break now 2610, we'll definitely have a melt up. We think it's quite likely that the market over the course of next week gives up something or basically goes sideways because NQ is very overbought. But as long as NQ stays above 6200, we think it'll go to 6500 by the end of the year without any any problems. It is actually more likely to accelerate higher the longer it waits than anything else. So be very careful of shorting NQ even for a trade. It is more likely to bust through to the upside in a very sharp move than anything else. Russell 2000 is now making the fifth wave spike. We don't anticipate it'll stop before 1530 to 1550, so at least 1 or 2% there. That's why if that goes up by a couple of percentage points, NQ could easily do double that. So it is very, very difficult to short this market. There are no signs of volatility buyers. There's no signs of volatility making a higher high, while the and creating a divergence against equities is just not happening. But what is happening is this super cycle. It is happening big time. It is just the trade XLK long against being short of the index, and then twice as much of the SPY. And this is all being driven in a way by DX, because as DX gets cheaper and cheaper, and we think it will continue with whipsaws to get cheaper, it makes the likelihood of US equities going down even less so. And it makes the likelihood of XLK outperforming even more so. So the market is being underpinned by the weakness of the dollar. Thank you very much indeed, and tweet you on Monday.